Look at the greats. If it's Buffett, if it's Tepper, if it's Drug, I don't know a single one of those cats that isn't like, yeah, you need some international exposure right now.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Daily Dots. And I am joined, as always, by the brain trust himself, Mr. Chase Taylor. Little relief rally, pretty technical. Didn't we bounce right off the previous lows here?
Yeah, I mean, I think we're still down on the week even. So yeah, we're not even up on the week.
Yeah,
so,
yeah.
Not that big a deal.
No, and Besant kind of sprayed a little alcohol into the intake there.
So the interesting thing is, so to catch people up, Scott Bessent in a closed door event with, I think, JP Morgan. So no media, no public, apparently said something along the lines of he expected a de-escalation with China soon because it was an unsustainable situation, which the market immediately jumped like 1% just on that. But we have 20 minutes left before the close as we record, but we're below where we were when he said it. So we're still in this regime of their commentary is not getting the market up. They're going to have to make real policy to get the market up.
Another thing that we were talking about before we came on today too, and I think it matters to point this out. The other thing I find is interesting on a day like today where the market did respond positively and jumped. You look around the world and international markets are effectively keeping pace.
Yeah, you're about 20 bips below for the all world or the ex-US all world. So,
and a lot of these are up 15 to 20 on the year.
Right. Exactly.
So, I mean,
or if you're polling 40.
Yeah. Why don't you, before we get into some of the specifics, why don't you get into the rundown on the indexes? And we're recording a little early today. Still got 20 minutes in the trading day. I would assume that would mean wherever we say the indexes are, they're going to be probably a good 30 to 50 bips higher when the market closes.
Very, very possible. Either way, S&P at the moment up 2.08. The Q is up 2.01. Small caps 2.56. Equal weight 2.2. Mag 7's up 2.4. And then ex-US is up 1.85. And then we have oil up about 1.7. Gold down 1.2. The rest of the metals kind of mixed, although copper up 2.6. Bitcoin up about a little over 4% on the day, which is notable. Dollar finally getting a bit of a bounce, up 0.6. And over in rates land, you have the 2-year up about 4 basis points, the 10-year down 2.
All right. Well, there's, and this is miners getting pounded today too. And this is kind of what we were warning people about, which is why we trimmed a good amount. I want to say about 20% of our gold book yesterday into this morning.
I can't do math that fast, but
it's about,
we trimmed some,
20,
yeah.
It's about 20%. And we'll probably trim a little bit more. Again, not a recommendation. I hate doing this. And the reason I hate doing this is because as well as the miners have performed, as I've said so many times, they're still dumb cheap when you look at the underlying metal.
Yeah.
And they're dumb cheap at $2,800 gold. It just is what it is.
Right.
And
but they were up 50% year to date coming in today. So they were making up the ground. It's just, and I like to fantasize about a time where you get a big pullback in gold and then metals stay flat. But today's price action makes you feel like, yeah, this ain't going to be that time. No. And I think the reason is because as incredible as it sounds, clearly, now I think it's in the process of breaking, but the fever has not broke. The irrational, completely mindless, unfundamental American markets, that fever is not broken. And so, I think investors see something like gold miners or gold as a short-term trade, and let's take our profits and pile right back into the same old games. Every time our dumpster the fire tries to go out, someone lights it back up. So.
Yeah. But I just think that there are so many tells out there right now that just, again, and I don't even think you need to look at relative performance to other indexes in the world. I just think I think they're going to the well one too many times on this one. And one of the this is going to sound funny because it's not a tech stock and it's certainly not one of the usual suspects. But ironically, I think that this name sums up the issue you've got in American markets right now. I think probably better than any other name. I think more so than Costco, more so than Walmart, more so than Apple. And that is Philip Morris trading now at 38 times earnings and 7 times revenue. Philip Morris right now is trading at an excess valuation to sales than the NASDAQ was trading at the height of the tech bubble.
What I called it this weekend was a staple meme. And
that's a beautiful way to put it.
Staples are the kind of staples and utilities. We talked about this yesterday. The kind of only game in town this year inside the US.
Yep.
So everyone's piling in and you can just feel it. Like there are people now, granted, some people literally have a mandate. They can't leave the US.
Right.
But a lot of people have it have like a fake mandate. It's sort of like the story of the elephant who, when it's a baby, you put a little stake in the ground. It can't get out.
Right.
It's full grown. Obviously, it can rip a stake out of the ground, but it thinks that it still holds it down. So it won't move. I feel like that's a lot of investors now. They're that grown elephant. They still think they're staked into the US. And so they're just going to go buy, staple memes instead of, grease at under 10 times earnings.
And look, this is one of the reasons we were pounding on the table on this coming into the year. And it's still very much, if you want to understand all of this, it is, to me, it's very, very simple. Go pull up a chart of the rest of the world's indexes over going back to 2009 and pull up a chart of the S&P 500. That is all you need to know. Why are these people bidding on these things and driving them up to ridiculous levels? I mean, 7 times revenue on Philip Morris. Did they start a cloud-based computing business?
I know.
Yeah, it's just insane.
They're on the blockchain, bro.
Yeah. But investors need to realize, if you want to know why this is going on, pull up the charts of the last 15 years. You've got a generation of investors and probably good portions of other again, you consider the fact that the normal economic cycle is 6.5 to 7 years, and that we effectively went 15 without a recession. You're going to change you're going to leave a mark, right? That's going to have an impact on investor sentiment. And that very thing that I think is dangerous to avoid, you and I were talking, it's very funny to hear the narratives and the hand wringing over the market, where I feel like this has been the most gentle, the most broadcast. We've said it before, but nobody rings a bell at the top. They did. And you've got all the signal, you've got all the fundamental, you've got all the comps, like it's all right there. Right. And watching people reaching for these US based names. If you want that kind of company, guys, you can find stuff that's every bit as clean, every bit as durable, every bit as safe as a Philip Morris, but you can get it for a 4th or 5th the valuation and double or triple the dividend. It just makes no sense. Right. I mean, unless we're trading Pokemon cards here.
Well,
I mean, which is effectively what you're doing. But I mean, if you're looking for better financial plays, if you're really looking at buying cash flows at a discounted price, sweet Moses, it's the best of it's the best of times and the worst of times all at the same time, right? Like,
which for thinking investors, just the best of times.
It really is. It really is. And one of the things that makes me nervous about it. And again, you and I have talked about this market, and one of the reasons I'm not nervous about it is because it's so bloody obvious. And obvious not in the sense that, look, I'm saying if you do this, you're guaranteed to outperform the S&P. I'm not. But in terms of what investing is all about, right? Look at the greats. If it's Buffett, if it's Tepper, if it's Drug, I don't know a single one of those cats that isn't like, yeah, you need some international exposure right now.
And speaking of this zooms out way more. But if you think about like investing and the way it's moving towards a lot of systematic, a lot of quant, a lot of, I mean, now we have AI that's there to help, big data processing stuff to do like really robust back tests on strategies, all this kind of stuff, reversion to mean trades. Like there's so much there. But if you think about how we're all optimizing for that, for the most optimizable parts of the market, and then you zoom out and realize, but if you have a 40-year regime shift, none of those strategies,
none of those
AI,
trends,
like none of this stuff is going to be like, oh, wait a second. Like actually the biggest gear, inside the machine is changing. Right. So like, let's think about this. Nobody's going to do that. Everyone's going to be like, well, my mean reversion model says I'm supposed to buy here. Right. My Z score says we're stretched in this direction. And so in that sense, it's even more powerful of an opportunity, because you realize none of the machines are geared to be like, hey, red flag, significant geopolitical shift like taking place. Like
that's not what they're reading.
Knows, right?
Yeah. And
all the options bros aren't going to pick that up.
No, and it's nerve wracking, right? Like I understand, to sit in at this point and say, look, you think your money's is going to be best treated outside the U.S. It's not something we say casually. I lived through the last 15 years too, man. We were discussing it on our investment meeting this morning, where I was just like, look, guys, I've got a lot of scar tissue here, right? There's been several times where this party was supposed to be over. Let's everybody reiterate what your outlook is. Let's make sure, as sure as we can anyway. But the other thing about markets, and I don't really know this, you and I knew 6-8 months ago that international markets were extraordinarily undervalued compared to the US. That wasn't what got us going, right? It was that all of a sudden those markets had a green light and also a need to repatriate some of that capital, right?
Yeah, it's that understanding that the dynamics of the trade were going to change, that had giant flow impacts for capital, and then the fact that we're going from being the only game in town for fiscal to everyone else joining the thing. If you think about fiscal over since COVID, let's say, and I mean, it really goes back to 2018, but if you think of fiscal from COVID on, it's kind of like the Homer Simpson meme of where he has all of his fat tied back on his back. So like from the front, he looks ripped, but then you see in the back and he's just got all of his fat like tied up. He's pulled it tight, That's kind of the U.S. economy in the last 5 years, because we just ran huge fiscal. Like you can make anything look good with that.
Yep.
And then the rest of the world, it was kind of like just asleep, like just not doing any fiscal. So yeah, like Europe looked like a museum because they were all just sitting on their hands with, especially in Germany, like really tight budget. I mean, not really doing much to deregulate or make anything make sense. They're just asleep. And then all of a sudden you have this moment where they come alive, they wake up, they start changing things for the better. They start spending money, they start reindustrializing, rearming, like all these things. Same even with Canada. Like, while we, are kind of just chugging along, doing the same thing, kind of going sideways, even talking about doing less fiscal now. I don't think we'll actually do less fiscal in practice, but talking about it. So you look at that relative basis on all that. I mean, yeah, of course the money has found its way out and back into those places.
Well, like you and I were saying, I thought you had a really good point when we were off camera, which was, I don't think that those guys, I don't think the Swiss National Bank all of a sudden decided, you know what, Apple's gotten too pricey, right? Like, everybody didn't find fundamental analysis overnight, right? It was a necessity. And then as these things are typical, I think the necessity, you kind of start repatriating some capital. Then you start looking around and going, oh, wait a second. Boy, this has gotten really off balance. Rather than repatriating 15 to 20, let's make it 30.
Right.
You know what I mean? And then and that kind of begets more realizations, right? More investors start going, whoa, wait a second here. Right. And that's, to me, is why Philip Morris is the perfect example of the problem here in the US. Why are you buying it? You're buying it because you don't expect even tough economic conditions to really dent their business model. And there's a lot of historical examples of that, right? Cigarette companies are the kind of things you want to own during recessions, right? But not at 38 times earnings or 7 times revenue.
And Staples themselves 24 times.
Right. The reason they go up is because the business models typically are not impacted by lower GDP because they have very inelastic, like they do not have, well, excuse me, you can look at it both ways, but they have a ton of elasticity with their consumer base, right? Meaning they're addicted.
Yeah, they don't take a 30% header on the top line just because of the recession.
Right. So it's not good because it's Philip Morris. If you want to own those things, you go look for other companies that fit that billing, and you can find them all over the world, right? And then you look at the currency situation, you look at the valuations, the dividends, and you're going, would I rather make 9% and be buying this thing at 1.1 times revenue? Or like,
right.
And I feel like in a lot of
Japan has staples too.
Right. Japan has staples too. Europe's got some staples. You can find them in Latin America, right? There's things that and even that have international exposure, right? So you're mixing up that currency. You know what I mean? There's plenty of ways to do it. And, you know, you keep looking at the US, just like, I can't believe people are trying to, just feels like you got raining knives all over the place and people are like running outside thinking it's raining gold, you know? And you're just like, dude, you're going to catch a cut coat of the dome if you're not careful.
And the currency part's a big part of that. Like, I think a lot of people, when they look gamed out the trade thing, they're like, well, U.S. stocks might get hit here, but maybe the dollar will be flat to up. And then so when the dollar's down, and if you're running $100 billion out of Europe or the Middle East or something, and you look, and you're heavily invested in the U.S., and you look at that, ooh, we're down 10% on our equities in the U.S. all of a sudden. Man, I would have made way more if I was overseas. And then you look at the dollar and it's like, and that's down 8%. So I'm actually down 18,
right?
Because I'm not hedged up. And now it's so expensive to hedge. No one's going to start hedging today.
No.
Well, no one's smart. So the answer is like, get out, right?
Mm-hmm.
And if you really think about this from like a kind of a game theory perspective, like truly the last one out to rotten egg. Like,
yeah,
if you wait till the end to be the one that gets some capital out and redeploys it somewhere better, I mean, you lose on both ends, like, because both prices are getting worse for you. All three, if you think of the currency, maybe like you have 3 prices moving against you all at once.
Mm-hmm.
And we see it, like we talked about this, like the door is so narrow for some of these overseas markets. Like think about Poland up 40. Well, yeah, like, I mean, we're down 10, they're up 40 in part because their door's a lot smaller than ours.
Yeah. And and it sounds crazy, right? It sounds like, oh, they're up 40. Well, yeah, this one will rotate back into U.S. assets. Again, go look at the relative performance over the last 15 years, right? No, these things have, you know, if you're talking about a mean reversion trade here, these things have a long way to go. And that's one of the troubles, right? Like that's what we were saying, all the hand wringing in U.S. markets, you know, usually if you're down 10%, 15% in a, you know, virtually 9 out of 10 times, if you're looking at a market in the US, anytime the S&P is down 12 to 15% year to date, 9 out of 10 times, actually historically, you're always over the long run, it's a good move to buy some things there when you're down 12 to 15, right? Every once in a while, like I said, one time out of 10, that 12 to 15% pullback is going to result in lower prices where that's going to be the bottom. But that's the issue that's the issue I go back in the United States. Everybody acts, oh, this was so hard. Then you flip over and start looking at the underlying fundamentals and you're like, God, rather than froth being burned off, I'm looking at this going, boy, these are still some pretty exuberant markets as far as valuations and fundamentals go. And that's the toughest part to me, right? And then you, like we were saying, you add in the comps to Europe and, you know, just, I mean, if like we've been saying, if fundamentals and cash flows matter, I definitely think that trade is in the infancy, and probably continue to sell rips here in the US, right?
Yep.
Look for individual valuations. I will always, I'll throw it right back. I think it is a tremendous mistake There's a term in investing called home country bias for a reason. It costs you money. Okay. There's a tremendous mistake of Xing out any market for macroeconomic reasons. And I'll say that to the US. There's stuff in the US to buy too. I'm not, saying avoid the whole thing. The problem is that US based investors are not diversified even inside the United States. Right. We're very concentrated, very concentrated. And yeah, that can't hold. What else do we see? Anything else out that caught your ear today or caught your eye?
Yeah. We had a little bit of data. We had Philly Fed's services came out terrible. So following the Philly manufacturing, which in a way you kind of expect, manufacturing to be a problem. To see services, now it's only one of them, but to see services kind of follow, not a good sign for the economy. And then Richmond had their manufacturing index come out, also bad. It was they have a capex indicator in there. It's the second worst print in the data for where capex is headed. And on the Philly side, especially less so on the Richmond, but the prices paid are just starting to hockey stick higher.
Really,
so you can kind of feel the early inflationary impulse starting to come through the price. All the prices paid in all the regionals and I'm sure we'll see it in the PMIs, ISM and stuff soon. But so higher prices, lower activity, kind of the stagflationary mix that you would expect from, the current policy slate. I still don't think that stuff's going to hammer like the hard data until summer probably. But as long as this stuff holds on, you're starting to see some of the early indicators of it. Of activity rolling over for sure.
Here's another thought I had. Here's a question for you. Let's say we got magical news overnight, okay? That trade war is resolved. We got to deal with China. I feel like this is kind of highlights the point I think we're both making here. Everybody goes, oh, U.S. markets would rip. If that news came out, everything considered, I'd rather own Chinese stocks.
Yeah, I'd still rather own all the ex-US stuff.
Yeah.
Now, do I think we would rip? Absolutely.
Yeah, I do. But I just think we'd rip 2 for 1 in those other markets.
Right.
Especially in China, where you're launching. Okay, so now you've got the threat of the trade war off the deal. You've got markets that are trading at a fraction of the valuation here in the US that have been pounded, right? Their Apple is still down 60% from its high, Alibaba, right? Ours ain't, right? And then you look at fiscal that they're putting on, which their fiscal is going to go regardless of whether there's something done in the trade war or not.
They need to emphasize the consumption no matter what. So,
and there you go. I mean, that's the other issue, where you're sitting there going, okay, let's play out your best case scenario. Today being a perfect example, right? A lot of those international stocks underperforming today by 10 or 20 bips after throttling them. Still, if you find out the trade war was off, I'd still prefer other markets.
Yeah. So to me, that's where the dips are to be bought. Now maybe there's certain US things you love and you just were a little skittish on that. You're like, all right, well, let's take a flyer.
Yeah.
If the news drops, but would I be looking to be, 90% long US at that point now?
The other tough thing about it, you got to think about, and this will not stop us from buying individual names that we think are at good values, but the inverse of the whole passive dynamic, meaning you could get some great deals on companies here in the US, right, that actually have good runways in front of them and have good things going on. And if we are right about the general trajectory of U.S. equity markets, and I've had this happen to me, you could sit on those positions and your underlying thesis could play out. And just the fact that people are liquidating passive ETFs, your stuff just keeps going down.
Yep.
That's the other thing you need to be careful of. So, all right, guys, that about does it for us today. We will, as always, we'll be back tomorrow. And again, all putting all these out in video now. So just go to YouTube, Know Your Risk Podcast. We're on TikTok, on Instagram, all over the place. Easy to find. You can also find us on Twitter at KYR Radio. Chase is at Pinecone Macro, right? That's your Twitter handle? Right. Yeah, I haven't said your Twitter handle in a long time.
Me either, so
yeah.
Sure.
Anyway, other than that, we're not too hard to find. And go to Know Your Risk Radio Podcast to subscribe. So until tomorrow, we'll see you then. You're listening to Know Your Risk Radio or Know Your Risk Podcast. Download and subscribe at knowyourriskradio.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.